Next, we'll look at how to finance your purchase like a professional investor. We'll start with some basics. With residential real estate, you can lend up to 95% of a property's value or up to 90% for an investment. Lender's mortgage insurance usually applies after 80%, with some lenders allowing up to 85% loan-to-value ratio before they charge lender's mortgage insurance. Lender's mortgage insurance protects the bank, it does not protect you. When banks are looking at serviceability, they're usually assessing serviceability at a stress test rate. This is to make sure that if interest rates do rise, that you still have the capacity to service these loans. Banks do not want borrowers who cannot afford to repay the loan. That's just bad business. So with your broker, some important questions. Which lenders do they work with? Do they have good working relationships with these lenders? Are they experienced working with a range of lenders? What are the niches of these lenders? Do they look at construction loans, or do they specialize in townhouse developments or self-employed borrowers? Or are they specifically looking at overseas buyers and expats? Will your broker go to bat for you when things get difficult? Will they be able to get the deal across the line within the required time frame? Will they be able to resolve mistakes as they arise? And do they understand the bank valuation process? Valuers are independent, but the broker may be able to highlight elements the valuer has overlooked. The broker can also request another valuation. And a big question is, do they specialize in investor lending? Do they understand the different investment strategies? Do they understand the 8 finance strategies that I'll outline over the next 10 slides? So the 8 rules. First rule, variable loans for flexibility. Second rule, interest-only loans for cash flow. Third rule, do not cross-collateralize. Fourth rule, diversify your lenders. Fifth rule, use an offset account or make sure your line of credit is not restricted. Sixth rule, be willing to pay more for flexibility and service. Seventh rule, expand your portfolio with the same investment partner. And eighth rule, lender's mortgage insurance and loan-to-value ratios, how you should approach these. We'll start with the first rule. So we want variable loans for flexibility because fixed rate loans have a break fee. Variable loans can be converted to fixed loans at any time without a fee. Fixed loans cannot be reverted to variable until expiry of the fixed rate period, or you'll have to pay this break fee. And this can get in the way if you want flexibility. Let's say if your property has really quick growth early on and you want to pull down the equity early on to buy the next property, then you don't want to be paying these break fees. It could eat up a lot of your deposit or a lot of the equity that you built up. With a capital growth strategy, if you want a fixed rate, keep it short term because you will be refinancing that property at some point down the track. Refinancing is very vital for a capital growth strategy. With a cash flow strategy, a fixed rate loan is less of a hindrance to expansion, as the capital for the next deposit is usually in cash. It's not completely in equity. However, there is always an element of capital growth in a good cash flow strategy. You can't pretend that it's not going to happen. It will happen. It will make things a lot easier when it comes to expanding as well. The second rule, interest-only loans for cash flow. So you want to minimize your tax deductions. You also want to be able to pay down the loan at your own pace. And you want to pay down, if you do own your own home, you want to pay down the non-tax deductible debt on that principal place of residence first, so you can continue to claim tax deductions on the rest of your portfolio on the interest payments. And it's just great for risk management. When cash flow is tight, you have the ability to pay less when compared to a principal and interest loan. However, you can still pay more than what you're required to pay if you do have extra income coming in. But consideration in the current credit environment must be given to the extra cost of financing with an interest-only loan. There can be a substantial cost difference in the interest rate. Third rule, do not cross-collateralize. Once again, we want flexibility. So we want one lender per property. The line of credit or offset account should be readily available on each property. And we want the flexibility to refinance one property at a time if we only need to refinance one at a time. Having all your investments cross-collateralized with one lender puts you in a poor negotiating position when it comes to refinancing and expanding, or even just leaving that lender for better rates and better opportunities with other lenders. So make sure you read the contracts and make sure there is no cross-collateralization in those contracts if you have multiple properties with one lender. The fourth rule, diversify your lenders. It just avoids the whole mess of cross-collateralization altogether. It'll ensure you're not cross-secured. You don't want to just trust the banks. They might overlook or they might put in a clause where you do get cross-secured. You want flexibility to select the best rate in the market at any time. And if you have multiple properties with multiple banks, it will be difficult for a bank to sell your whole portfolio in a default situation. It also allows a bit more flexibility to draw down equity from a range of different lenders. And it's easier to refinance each individual property. Fifth rule, use an offset account or make sure your line of credit is not restricted. So for this one, read the contracts, have your broker read the contracts, be certain of it. Offset accounts can be more expensive, but they offer more flexibility with fewer restrictions. A line of credit, a standard line of credit can be cheaper. However, the lender may restrict access to withdrawals when you need it most. You may be able to negotiate these restrictions with lenders prior to signing the loan contracts. Once again, have a chat with your broker and investigate whether his relationship with each lender is at the level where he can negotiate these clauses. Check the contracts and ensure you have full unrestricted access to your money. Sixth rule, be willing to pay more for flexibility and service. Basically, be cheap when saving money. Don't be cheap when making money. You want quick access to your equity to capitalize on opportunities quickly as they arise. This flexibility will help you make money. You want to pay down, refinance, and redraw your loans as you wish. No frill loans and crappy service may lead to missed opportunities, and that can be much more expensive than what you're saving on those loans. Seventh rule, expand your portfolio with the same investment partner. Most lenders will assume you are liable for 100% of the debt in a joint loan. Multiple investment partners is very messy. Good luck to refinancing to buy another property if you have many people investing with you at the same time. They will all have different views. The banks probably just won't even look at you. Borrowing capacity will be much higher, much higher, if you stick to just having one investment partner and you repeat the process with that one investment partner. And eighth rule, LMI and loan to value ratios. So with your first property, if your first property is your own home, an LVR up to 95% can work. You just want to make sure that that property is a high performer. Your second property, you wouldn't be looking at 95%, it would be an investment property, so you'd be looking up to 90% LVR, loan to value ratio. Somewhere around 80 to 90%, you can do for your second property. But as you get more accumulated assets and more properties, you'd be looking at protecting the wealth you've built up rather than accumulating more and risking what you've already built. So you'll slowly pull that LVR back to around the 80% mark. If you can aim for 75%, it'll give you a bit of a buffer if anything comes up. 80% is still comfortable though.